thinking that this distressed notes, a lot of people have confused on that. And people think that the mortgage payment who have failed to pay and it was taken by the bank. And then the investors come into the play and getting that for a discounted price. So is that a right term to that? Or how you seeing the term called distressed notes?
So when I'm talking about distressed notes, it's the mortgage. It's the 30-year mortgage that's on the property, right, that the borrower should be paying. And a distress note is where somebody has not paid in usually 90 days or longer, you know. So that's when the bank starts to realize, hey, they start to accelerate things a lot of times to start the foreclosure process, to start the notice of default, filing the lis pendens if you're in a judicial state here in the United States. So that 90 to 120 day period is where the banks then really start to ramp up and start that process. Now, not every bank will start it. Something like I just got in a list literally 5 minutes ago of over 700 non-performing mortgages, all first liens on a variety of mortgage products, whether it's FHA or VA or whatever like that aspect of things. 30-year mortgages and 40-year mortgages where the borrowers haven't paid in 6 months or longer in a lot of
Hmm.
cases. So the banks, for every month that a borrower is late on their mortgage payment, it reduces the value of that debt. Okay. So usually if you're a month late or you're rolling 30 days late, like some people will take advantage of, that mortgage is worth 90, 95 cents on the dollar. So if you're a bank and you wrote it for $100,000, that mortgage, and now they're late by 30 days and it reduces the value of it, that's not good if you're a bank, right? It
Yeah.
reduces the value of your portfolio. And for every non-performing note you have, especially if it gets in default beyond 90 days, you have to hold money back in reserves to offset those losses. And that's how banks make money is they don't want to hold money back. They want to lend it out 10 to 50 times. They want to, that's how they make money. So for me to get involved, it's usually got to be where a borrower hasn't paid in 6 months or longer, because then it's a bigger discount for me. I can go then buy that mortgage, not the property, the actual mortgage at a huge discount, 30, 40, 50 cents on the dollar, just varies on or discount off the property value. And now I take on that responsibility as the lender. And then
Hmm.
I can still allow that borrower to get back on track, start making payments, allow them to do a short sale, allow them to sell a property, or go the route of foreclosing. I literally step into the bank's shoes and have all the same rights. And then I can go from there. But the fact that I buy it at a bigger discount gives me more flexibility because my cost basis on that note isn't 100,000, maybe 50,000. They owe 100. It gives me the flexibility to work with them to get them back on track and make a great return on investment for me.